This is part 3. As the first bullet states, we can improve our financial performance by improving our supply chain performance, sometimes drastically. I have a friend who managed a machine shop. He was responsible for breaking down returns and refurbishing them, or his team was. A lot of the equipment became scrap. He figured out a way to recover gold from the bearings. Yes, gold and silver can be bearing lubricant. The metals increase the life of the bearings. Oil and grease break down. Gold and silver don't. Anyway, his recovery increased by $4 million a month, but that savings is sometimes hard to communicate to plant managers and CEOs. We will explain a good way to do that later in this chapter. Okay, the second bullet talks to the amount of capital we tie up in inventory. We always need to ask, is this the best way to invest our capital? Another way of saying the third bullet, which is related to the second bullet, is inventory is like grease, or gold, when it comes to filling orders. The more we have in strategic locations, the faster we can fill orders, and in turn, receive payments. Okay, there's a lot to this slide. What it is trying to get at is the relationship between sales and cost savings. As supply chain professionals, we don't get sales commissions. That seems obvious. At times, those sales and marketing folk seem to get a lot of attention, and managers usually understand the importance of selling $4 million more in a given month. On the flip side, when I say to my manager, I just saved the company $4 million, I might get a, wow, great job, at best. At worst, I might get, well, that's why I hired you, as if we are a necessary evil of doing business. Okay, so back to the equations. The gist is we can convert supply chain savings into sales dollars. In other words, how much more would you have to sell in a given month to add the same dollar amount to the bottom line? It turns out the last equation, the one at the very bottom, is the answer. Just replace the term profit with supply chain savings and divide it by the profit margin. Yeah, I know, math. Don't worry. I have some examples prepared for you. Just note the equation. Sales, meaning sales would have to increase by this amount to equal the savings divided by the profit margin. Okay, let's try a few examples. If we look at this graph or this chart table, you'll see the profit margins listed near the top in percents. So stay in your columns because the 20% profit margin is at the top of this column, and then it says 50,000, 40,000, 10,000. So let me explain what's going on here. At a profit margin of 20%, if I do something that saves the company $10,000, how much more in sales would I have to sell to have the same impact to the bottom line? That answer is 10,000 divided by 20%, or 10,000 divided by 0.2, and that equals $50,000. So my sales team would have to sell $50,000 more to equal that $10,000 worth of cost savings. Now, this gets even bigger the lower our profit margin. So at a profit margin at 5%, if my supply chain team finds a way to save the company $10,000, I would take the $10,000, divide it by 0.05 or 5%, and that means my sales team would have to sell an additional $200,000 to equal the same amount of money to the bottom line. Now, think about my friend, right, who did the gold recovery. He recovered $4 million a month. Their profit margin was 24%. So how many more dollars in sales would we have to realize in order to get the same amount to the bottom line? So I take that $4 million and divide it by 24%, or 0.24, and that equals 16,600,000 ... So an additional almost $17 million in sales to get the same bang for your buck. We can use that type of information and take it to our higher managers, especially when we actually do some cost savings here and there. And then we take that profit margin, we apply this equation, and we say, hey, you're willing to do this ad campaign hoping to get an extra $10 million in sales. For that same money, I can get you $6 million in savings. But I need an extra couple guys on my team. So we can justify some costs, some hiring, that kind of thing by using this equation. It's a great way to communicate, especially when you're communicating to people who used to be sales managers. And that's how they moved up in the company. They don't really understand the supply chain thing, but they sure understand the sales thing. And if we can convert it into their language, then they say, oh, I get it, and they're willing to invest in us. Now we're looking at the supply chain relationship to our financial numbers. And this is something that stockholders are really interested in. But I'm going to read a lot of it because it's pretty straightforward. A major financial objective for any organization is to produce a satisfactory return for stockholders. That seems pretty straightforward. The absolute size of the profit, so how much money the company makes, must be considered in relationship to the stockholders' net investment or the company's net worth. An organization's financial performance is also judged by the profit it generates in relationship to the assets utilized, or return on assets. We call that ROA, which is one of the typical financial indicators we look as we're evaluating stocks. So we're saying that the performance is also judged on the profits it generates in relationship to those assets. And a lot of those assets are supply chain related. Again, reading from the slide, the supply chain plays a critical role in determining the level of profitability in an organization. Return on assets is a metric that is used as a benchmark to compare management and organizational performance to that of other firms in the same or similar industry. Again, we're using benchmarking, or the idea of benchmarking, to compare how well companies are doing. And in this case, we're using return on assets as a standard benchmark we use between companies in the same industry and companies in diverse industries. This slide is a great depiction of return on assets. At the top you see a hopefully familiar equation in which profit equals revenue minus costs. A lot of those costs can be influenced by supply chain professionals. Further down we see what goes into the capital we use to generate profits. The first box on the list is inventory. Inventory can eat up an incredibly large portion of capital. Okay, accounts receivable includes the money the customer owes us, meaning they've already received the goods or services, but they have yet to pay for them. These accounts are constantly being watched by the accounting departments. Cash is cash, but it means that we have cash that is not being used. Sometimes we need a little bit in the bank to make sure that cash flow is not a problem. Too much cash in the bank is a bad thing. Companies need to either reinvest it or pay it back to the stockholders in the form of dividends. Fixed assets? Well, that would include buildings, machines, trucks, etc. Our mission is to reduce the cost of the overall costs and turn the inventory into accounts receivable. Once inventory becomes accounts receivable, the accounting department can worry about collecting on them. This is a great slide. Here we see the various ways supply chain professionals can increase the return on assets. Under channel structure, in that box, we can use outsourcing as a way of minimizing capital investment, something we've talked about before. We can also monitor inventory levels, trying to maximize their effectiveness in providing good customer service without having a lot of extra inventory sitting around. As you can see, inventory has its own box. Here we want to make sure that we have what we need where we need it. I'll let you look over this graphic, but I want to point out one other thing. The one thing that is consistent in each area is improve information. I have found that by improving the information I receive and the information I give throughout the supply chain, this tends to reduce costs and the need for capital investment. In this slide, we're connecting the balance sheet to some of the metrics we use as supply chain professionals. Cash and receivables are directly related to order cycle time, order completion rate, invoice accuracy, and on-time delivery. Inventory levels are directly related to service levels and stockout rates. I'll let you read the rest on your own, but make sure you see the connection. Supply chain influences the balance sheet. Okay, this is a canned slide that the publisher gives us. I thought it was worth saving and showing you. I actually thought it was funny. Quote, reducing the cost of transportation, warehousing, or inventory by 10% will lead to significant impacts on the financial statements. Okay, this probably is very true. In fact, I would say, while this is very true, be careful. Remember, through experience, we have learned that trying to save money in one specific area without seeing the supply chain as a whole, well, you might see the savings in that area, but it leads to the silo effect. You might save a lot in transportation, but the cost and the extra inventory you hold to do so, well, that might just be a lot more than you save in the transportation, right? And have an incredible impact throughout your supply chain. So we don't try to just be efficient in one specific area. We have to look at the supply chain as a whole and reduce the costs, the overall costs. This slide kind of goes with the slide we just went over. What we're saying is that, look, the results in supply chain service failures. So if we try to be too efficient or reduce inventory too much to make our ROA look really good, that might lead to service failures. And those costs can be big. Not only do the customers experience the service failure, and that reflects poorly on our company, they might request the orders be corrected, or they might refuse the orders altogether. The refused orders, that can be a lot of lost sales revenue. Not only might they refuse the order, but they might decide not to come back for us for further orders. For the rectified orders, the customer might request the invoice deduction to compensate for any of the inconvenience and added costs. In other words, like the previous slide said, hey, you can, if you save 10% in any of these areas, it will really affect our balance sheet. True. But if we do that at the cost of our customer service, if we don't do it correctly, there's a lot of financial implications. Now, this concludes this chapter's video lecture. I still want you guys to go through the questions in Canvas, make sure you can answer those, and they have a good grasp on those. Hopefully I covered a lot of those in this lecture. If I didn't cover it in the lecture, it doesn't mean that it doesn't need to be covered by you. Be diligent, go through it, make sure you understand it, and good luck.